Joining us now with more on the markets, Bill Eigen, Chief Investment Officer of the Absolute Return Fixed Income Group at JPMorgan Asset Management. I just threw out the notes because of our conversation, during the break, Bill, because of some of the things you intimated to us about your opinion on inflation, because it matters. It matters so much, and we've talked about it so much. 2%. The last mile, getting there.
Good luck. Good luck.
Then they got them. They're still cutting. They're already cutting, so that makes it.
You know what's funny is if you were an alien, you got dropped out from space into the country today, and you looked and you said, okay, we're growing at 3.2% this quarter, just grew at 3%. Inflation dropped to the mid-2s, now is turning up into the 3s, right? You've got equity market at all-time highs, up 30%, crypto going through the roof, roaring kitty moving meme stocks, as I heard you say before. Volatility at the lows, risk premiums for all forms of fixed income at the tightest levels, not in the last 5 years, but ever. Right now, you would say, okay, I guess the Fed's tightening, right? No, they're going the other way. Right. They're cutting into an accelerating economy with inflation turning up. And I look at that, and it kind of reminds you of when they started tightening. They waited till inflation was at 6 to 7% before they started tightening, and now they're easing into this environment that's pretty favorable. And the question I always ask myself is like, all I hear, and you guys hear this all the time, everyone tells you rates are restrictive, right? Why? Why are rates restrictive?
Yeah, where's the evidence?
Everything I just pointed to.
What's being
is that restrictive?
We've asked the same question.
The housing market's doing very well. Mortgage originations are turning up. I mean, all this stuff. I mean, I own a couple small businesses, which, as we talked about,
they did.
And the inflation pressures I'm seeing, particularly as it relates to employment, services, and shelter, are not only sticky but moving the wrong way. And I don't know why this doesn't make it into the conversation.
I would say for a while the 10-year was doing what you would think it was supposed to do, but why is it? Is this a global thing now?
It's fascinating to me, right? And usually I'll say this, like after the new administration was elected, Treasuries reacted and the 10-year went over 4.5%.
Yeah.
And all I'll say is usually the initial reaction markets is usually the correct one. And since then, they've announced a Treasury secretary that they believe is going to be bullish for bonds. I don't quite understand that. But the economic data since the Trump administration got elected has been nothing but strong. It's been beating expectations pretty much everywhere, with the exception of a slight miss on the services index the other day.
We've in the past. Well, I got a couple other things. Number one, so they're going to move the goalposts. That's the only way they're going to say we did it. They have to.
Yeah.
They're not getting
Fed in terms of inflation.
Yeah, they're not getting it to anytime soon.
The neutral rate's way higher.
But then on a more long-term, in just sort of a worrisome issue, we've had Grant on.
Yeah. Deficit?
Not Mark, Jim. When you have a 40-year, once-in-a-lifetime bull market in bonds...
I was just going to say that.
Does it end with this little whimper of inflation, or do you have... his viewpoint was you're going to have a multi-year bear market in bonds, which would imply higher inflation.
Well, let's look at it this way. Already, when you look at the 5-year and 3-year return on diversified bond indices like the aggregate bond index, people always forget that they're negative. You've lost money for 5 years in bonds. We're talking about an asset class where you haven't made money, and yet everyone's all excited about it all the time. I'm an absolute return manager, which means I look at things objectively, right? I look at everything objectively because I need to produce positive returns regardless of what markets are doing, and that forces you to focus on the math. I mean, bonds are math, right? It's pretty simple. You know, when interest rates go up, you lose a lot of money. Right?
I mean, this cycle after that bull market, is 5% Fed funds going to be the high? Is that going to do it? That just doesn't. It seems like we could go back there, and if we are going back there, be easier. We're going back there from a lower number. They're going to keep cutting, and then we're going to have to get.
Yeah, I really think they need to reconsider this cutting path they're on, given the data. They say they're paying attention to data, right? They say data dependent.
They always say that, but it's always.
But then, and then they keep cutting. Right?
Even the rearview mirror.
So as far as next week, what are they going to do? I know what I think they should do. I think they should stop. Because, maybe the neutral rate is around here. Who knows? Based on what I'm seeing in the economy and inflation, I couldn't say no, right? But I think...
You'd be lucky if the neutral rate was here.
Yeah.
Probably even higher.
And, the way I look at it, another thing that concerns me is that no one really talks about that much is the deficit, right? Like, if I were to sell you a bond, if I owned a company that took in $4.4 billion in revenues and spent $6.3 billion, would you buy my bonds?
No.
Of course not, because that's called bankruptcy, right? What do you call a country that takes in $4.4 trillion in revenue and spends $6.3 trillion? Call that the USA, right? And they fill the hole with what? Treasury issuance, which is up to $37 trillion now. $271,000 per taxpayer? you got to consider that for the long end at some point.
Where are these? What would be a good name? How about Where are these vigilantes?
I think they'll come out at some point. And again, I'm not sitting here being Mr. Bearish on bonds. All I'm saying is that if you're going to be objective in bond land, right, focus on areas where you know you can make money pretty safely. Like, for instance, right now, the cash to 10s yield curve is completely inverted. You can get almost 5% in your cash, and yet everyone's telling you to buy 10-year treasuries at 4%. Why? Why do I want to get paid less to lend this over-levered government my money for longer? It's pretty simple. I should stay on the short end.
What would you yield on the 10-year would you need to buy it?
Well, it would depend on where cash yields are. Where
cash yields are right now, what would you need?
Way more than this. I need a positively sloped yield curve.
5.5?
Right? In the fives.
In the fives.
Right, to be honest. It may be high fours, but I need to be getting paid a reasonable amount more than what I can get paid overnight. Right? A such thing as what used to be normal.
So then the auctions are going to start going poorly, and they're going to tell us.
We had a terrible one. Remember, just 2 weeks ago, you had a terrible 20-year auction that went at 468 and tailed, right? That told me something. I'm like, wow, there's not a lot of interest out there, is there? Like, people are getting nervous about the long end of the yield curve. And I don't see what's going to reverse that in the near term. And by the way, all the things I'm talking about are actually good for risk. Right? They're not bad for stocks. They're not bad for things like convertibles and other areas of the market.